Hello, everyone, and thank you for joining us. Let's start discussing this panel, which is, I believe, is an area of interest for most of you, and that's the reason you guys are here. We're going to discuss about navigating the risk in the wild world of cryptocurrency and blockchain. To begin with, let's start with some numbers. Digital asset user perception rate, that is the number of users, how it's growing globally. In 2022, we had almost 446 million users. In 2027, we can see, and there is a forecast of 1,023 million users. So compound annual growth rate, what we can see is 18.6%. The UAE is reported to be the higher user penetration rate found globally. The value of cryptocurrency transaction received by the UAE reached nearly 35 billion between July 2022 to June this year. This is amid increasing regulatory clarity. While this represents the 17% drop in the previous year because of crypto winters or whatever, the UAE crypto market is still leading than the other countries in the region, say for an example, Qatar, Oman, Lebanon, or Jordan. The MENA region is the sixth largest cryptocurrency in the world, with an estimated 389.8 billion on-chain value received between last July and June. Last March, Dubai adopted a law to regulate virtual assets and provided their investors a safe environment. We have VARA in the country as well. Globally, the regulatory focus on digital assets has increased dramatically over the last few years. The market confidence is the validation of the efforts made by the country leadership to offer regulatory clarity and establish the nation as a global crypto hub. With this note, let me introduce myself. My name is Sheetal Bhardwaj. I am the head of virtual asset compliance for the Commercial Bank of Dubai. Commercial Bank of Dubai is one of the banks which has decided to have this dedicated department of the virtual asset and its compliance. I'll be moderating this panel today, and where we will navigate the risk of the cryptocurrencies. I'd like to welcome our diverse panelists here. Let me introduce our panel today. Babar, who is the head of AML compliance for Visa. Alina, who is the head of compliance for MidChains. I have Amardeep here, who is from Chainalysis, and Gaurav Dubey, who is the CEO for 𝐷eFi. Before I jump into the question, I possibly ask our distinguished panelists to tell more about themselves. Maybe Babar, if you want to tell us something about you more.
Thank you for the introduction. So as people have said, my name is Mohammad Babar. I've been in the region for about 17 years. Maybe just a little bit of a history of what and how I came across cryptocurrency might interest you. Is I was in Bali in 2017 and ran out of cash and got onto a scooter and said, "Can you take me to an ATM machine?" And interestingly, the storekeeper got me to an ATM machine that had a big Bitcoin sign on it. And I looked at it for a while, and then I got back to her and said, "That's not a normal ATM." And she's like, "Oh, you don't have Bitcoin?" And then, of course, I went to the normal ATM. So my foray into the cryptocurrency on a personal and professional level has been since 2017. And currently, I do assist with kind of endeavors that Visa has on the crypto side from an advisory perspective in CEMEA.
Gaurav?
Fantastic. Thank you for the introduction, and also thank you, Baba, for setting up the pace. I think this is the most interesting introduction or way of introduction I've ever come across. I don't know, I've spoken on stage for more than 200 times. So I'll actually pick up on that because I think that would be interesting for the audience sitting here. I bumped into cryptos making a payment solution on Stellar, which I actually didn't knew was a cryptocurrency. I had a advertising business that was doing about $200,000 to $300,000 a day in tickets of $5 to $25. And you can imagine in 2015-14, a payment merchant would shut down on me every day, and a bank account would shut down on me every second day, right? So I was like hustling my way through the streets of Hong Kong and Singapore, and sometimes in Dubai, to get a bank account and payment processor. And that's when somebody told me that there's this system called Stellar, now called Lumen, that can actually process something as small as a cent, and there's no way they can close us. So that was my interaction with crypto, and since then, we as a group have been the solution makers. And because of that extensive expertise, which is where my introduction comes, 3 years ago we decided that we want to bring this on-ground, in-hand, real expertise to startups, both in terms of compliance and as well as expansion to be a scale-up and partnerships with larger enterprises. Because without that, there is no real growth in any industry possible, unless and until you plug into the legacy industry in one way or the other. It doesn't matter how big or how innovative you are, it would never serve the population. So that's what we're trying to do. TD5 is a crypto incubator and advisory, like I said, and we've been investing in Web3 since 2015.
Thank you, Alina.
Thank you so much for the introduction. My name is Alina, and I have started my career back in 2011 as a lawyer in technology field, and then I gradually shifted to regulatory compliance in fintech. I don't have any romantic story how I did fell into cryptocurrency. However, I was part of MidChains since the day one. I was part of the team who helped to get approval in principle to receive FSP from the FSRA of the DGM to complete all the conditions and successfully went live as one of the first globally regulated cryptocurrency exchange and custodian. Thanks.
Amar?
That's the difference between a love marriage and an arranged marriage.
I think
Good.
arranged one is more sustainable.
Good morning, everyone, and again, thanks for the introduction, and thanks for having me. My name's Amardeep Thandi, so I head up the regulation and compliance side of Chainalysis, a blockchain analytics provider, and really my main responsibilities are to help and support licensed financial institutions and crypto-native businesses in creating and building out their frameworks, policies, risk appetite statements, and then translating those into technology solutions to really control and manage risks confidently when it comes to cryptocurrencies. Prior to that, I was involved for the past decade in financial crime investigations, specifically around regulatory enforcement actions, DPAs, and supporting licensed financial institutions in their responses to regulatory authorities and central banks. I then moved on to do the same for blockchain or VASPs across Europe, Middle East, and Africa. In terms of my, I guess, origin story that we're bringing up here, I think back in 2012, 2013, one of my colleagues from work comes home one day and basically tells me, right, I've got these friends in South Africa and they're mining Ethereum. And the first image that I thought of there was a couple of people kind of, with pick shovels and actually mining some sort of mineral or some metal. And I said, what is Ethereum? And then obviously my path started. So I read the Bitcoin white paper, was amazed at the decentralized ledger technology and concepts. Then when I went on to read the Ethereum white paper, the concept of smart contracts I thought was something that was really, really going to change the way that the world works, and specifically the financial world works. And so that was really how I started my journey.
Thank you, Amar. So I think, let me start with you only, because you do a lot of work on the policy side of the business, and I keep reading a lot of publication from your company. Can you please describe how the virtual asset regulatory landscape has evolved globally over the past decade, and how far have we come in taming the Wild West?
Yeah, fantastic question, Sheetal. I guess it's no surprise it's been a roller coaster, right? If we start with kind of the emergence of Bitcoin in 2009, we had, I would say, the first 5 years as being possibly the most wild. Lack of education, lack of any form of regulation, and really a lack of understanding about what these assets are. And I think really moving on beyond that, we've seen a number of bans globally occurring. So I think, this morning we discussed about how, a number of nations were looking to ban, and there still are some bans prevalent in certain jurisdictions of the world. But we now know that bans don't work. You know, it drives the users underground and increases the consumer's risk. And so really what we've seen is, I think around about 2018 was a real turning point when we talk about, you know, taming the wild west of cryptocurrencies. And that was the emergence of the FATF Recommendation 15 to do with how do you control, manage risk when it comes to AML, CTF risk with cryptocurrencies, virtual assets, digital assets, crypto assets, whatever you want to call them in the world. And I think really where we are right now, you know, and where it started was really to try and understand what the assets were, try and classify and categorize the assets. You know, we have utility tokens, you know, we have different forms of stable coins and so forth. So really understanding what the assets were, and then really kind of trying to define where these assets fit with real world or current financial instruments. And so we've seen them trying to be kind of pigeonholed into or labeled as securities or commodities and so forth. And obviously the US are having quite a lot of fun with that right now still. And I think really from the 2018 standpoint, with the emergence of the Recommendation 15 and FATF, we really then seen you know, regulations picking up. And I think really where it started was from an area of risk. So the cryptocurrency industry was relatively contained. There was guidance being issued, you know, red flag indicators and so forth, and a series of publications from FATF to really provide guidance on how to manage risk. And so what we've seen with increased adoption over the years really has been then an extension of that, and especially with you know, what's happened in the industry, let's say in 2022, last year, and more recently with governance issues and certain collapses, is an extension of the responsibilities or the guidance that has been issued. So what we're seeing now is not only how to manage risks from an AML and CETF perspective, but also more broader than that. We're looking at market manipulation, market abuse, you know, financial stability concerns, prudential requirements, and all of these you can see, for example, in you know, the introduction of MiCA, for example. And so we're really, you know, I think we've come a long way, I would say, since the early years. Still a work in progress, but we do have, you know, a number of licensing regimes, and I'd like to commend the efforts of the local, you know, efforts that have you know, really laid the groundworks for this region, specifically the UAE, specifically ADGM, VARA, and the local government here. You know, we've seen some, you know, real guidance and the real clarity that's required to manage the risks and build frameworks, you know, and actually allow the industry to really innovate, you know, in this region. And so, you know, I think we've come a long way since, you know, the early years of crypto.
Sure, thank you. That was quite insightful, Amar. Babar and Alina, you both are working, he's in Dubai, you are in Abu Dhabi. We have VARA in Dubai, we have FSRA, DGM, we have DFSA and the IFC, and then we have ESCA as a federal regulator. So if I talk about the country, what do you want to talk about the regulatory efforts? Do you think we have done significant efforts in developing the framework around it, given recommendation number 15 on the FATF, remains still partially compliant for the UAE, and we are still in the gray list? What do you think? Have we done enough? And is there enough and more regulatory clarity here by the regulators?
So, first of all, I would like to admit the efforts from the regulators, and UAE has delivered its intention to become the world's largest hub for the crypto assets. And each regulator treated differently the FATF recommendation 15. However, all of them have admitted the importance to adhere to this rule. ADGM has provided some certain guidance, and it arranged infrastructure, and it invited travel rule solution providers to test and to create the testnet for the market participants, right? VARA provided slightly more clarity. They set up a threshold at 3,500 dirhams. They provided clarity within the scope of reporting, what exactly should be accompanied with the transaction, the beneficiary name, the originator name, the wallet address, or the IBAN if it is a fiat transaction. So, I mean, talking about implementation of FATF Rule 15, it's important to understand that whatever we are hearing from the market, it's mostly about uncertainty, unclarity, compatibility, right, that it needs to be harmonized, interchangeable. However, my personal view that it's not possible to achieve any of this, but travel rule is in there. It's for the benefit of the industry, it's for the benefit of the clients, and eventually all VASPs have to adhere and have to comply. Bear in mind, threshold is 0 because MiCA already implemented 0 approach, and I see it as many different solutions will be implemented, and perhaps VASPs will have to implement more than one solution.
Absolutely. What are your views on this, Babar?
I think it's been covered really well, so I think we can move to the next question.
Sure. So I think continuing to what Amar, Alina, and Babar has just echoed, I have one question, and which is a question from me as well for the esteemed panelists. We have so much regulatory clarity from the local regulators and international governing bodies and the organizations as well. Why till date, all the banks are still hesitant in onboarding the WASP? What is the inherent risk which you think is not being mitigated, and why they are like touch me not kind of an industry, and still, you know, I mean, even here now, if you talk about none of the WASP is banked by any of the mainland banks. So what do you think? What is that hesitancy? What is that which is missing, and why we are not able to connect that dot? What are your views on that?
Yeah, great question, Sheetal. I think, you know, I work a lot with banks, you know, and, you know, there's a lot of developments right now and a lot of innovation happening. You know, whether it's tokenization, whether it's, you know, allowing customers to operate and create a white label solution for them to invest into cryptocurrencies through a partnership with a cryptocurrency exchange, for example. And really, I think to answer the question, why are the banks so hesitant? I think it's being comfortable with being able to manage the risks. And when I say being comfortable to manage the risks, when it comes to, say, banking a VASP, it's really understanding the types of questions that you need to ask. So typically, from an onboarding perspective, I would relate kind of banking a VASP to onboarding a corresponding bank, you know, or starting a correspondent banking relationship with a partner. So what you're looking to achieve is to understand, to a certain extent, their operations. And, you know, historically, you know, there'll be documents that are requested, and you go through the policies and you have a look at, you know, whether or not you're comfortable with the level of exposure to that financial institution. Now, with public blockchains, there's a significant amount of increased transparency. And so imagine starting a relationship with a correspondent bank in the fiat world and being able to see every single one of their transactions historically from their inception, and having to see exactly when there has been either illicit activity in relation to sanctions, to you know, scams and so forth. This is the level of detail that, you know, on-chain data provides you. And I think it's, you know, the conversations that I'm having now are a lot different from a couple of years ago, where the compliance teams within banks, through kind of, you know, some of the certifications out there and the education out there right now, are really starting to understand that the risks can be managed. And it's being comfortable with those risks and understanding the specific nuances that crypto brings with it.
I just want to take that point and just highlight, these are my personal conversations with a couple of CCOs. I think the elements that the banks are struggling with is technology. If you really look at how the risk assessments, and I think that we're going to discuss later, prior to blockchain technology, whatever assessments that the compliance department, the government's department had to do, didn't have that much technology elements attached to it. Now, let Gaurav maybe come in as well. I think one of the key challenge, as Mohammed Shalom as well highlighted, is the traceability, to the extent that it is explainable to a regulator. and to the point of about actually being able to look at the source of funds of some of the VAFs as to what the area which we call private custody, which is private wallets. And if you look at a lot of institutional side of things, this is where the funds come from. A lot of big clients don't keep their funds on public exchanges. They keep it in non-KYC, non-custodial wallets, which needs a little bit of work, and I think Gaurav is in a better position to maybe explain one of the areas that he might be working on to resolve this. But for me, it's been the lack of technological understanding of what the underlying blockchain technology is, and then to be able to use the governance language to go to your boards and the governance committees and give them comfort. That, in my opinion, is a big challenge for the bank CCOs.
I agree. I agree.
To add on to this, I would say I'd want to recall a panel at the same event last year, where I was the one to highlight and the point about the traceability of funds and rather value, as we call it in the Web3 world, in the blockchain scenario. And while the panel was struggling to establish the point that while they can track the real money, the cash, to certain explainable boundaries that makes them comfortable, blockchain is for them, a black hole that simply emits or absorbs a value. And I was trying to bring the same point that Amardeep highlighted, that blockchain has immense and almost unlimited traceability. If nothing, then at least better than cash, right? So it is clearly, like I'm saying that in bold, right? It is clearly a lack of understanding, right? Somebody has to, shake them and show them this is the difference between the new tech. But the problem is, as humans, we have been, these animals. We just can't take innovation on the face of it. We don't want to spend those 5, essential hours to educate ourselves. And this is one of the things, I requested you that I would highlight. So before even you ask, I would rather jump on hoops on this quickly. At a very layman level, just to address everybody in the crowd, what does compliance look like in the real world? You add a KYC, you complete your KYC with an institution. They know where your funds are coming from. They can point out everything about your value or the value you create or transfer through a system. Then there's a inherent transaction forensics. I mean, I'm still talking about the modern world. There's a transaction forensics embedded in, there are transaction forensics embedded in an institution that also gives additional info on these funds. Sure. I think that's pretty much compliance. And then on the top, of course, the regulators talk about how it should be used and all of that. Guess what? This can be coded in crypto or blockchain. Now you don't want a person to actually validate KYC again and again, because if it's on-chain, consider it validated within a few seconds. That's what blockchain essentially solves, trust, right? Now, not today, but since 2017 is when I heard the first project, 2016, December exactly, that came up with the concept of a KYC'd chain. So anybody entering into that chain ecosystem essentially is KYC'd. You just created a coded institution right now, or at least the beginning of an institution. Now, any instrument functional inside this ecosystem is KYC'd, okay? And then because it's a blockchain, forensics doesn't even have a question. Like, it is intrinsically tracked. Everything can be tracked on this chain now. And this is 2016. Since that day, we have come a long way. On the side of development, we have created instruments. Now every single instrument, and I said this yesterday as well from the stage, every single instrument, the value coming in, the value going out, the value held, we call it TVL, I mean everybody calls it TVL. Everything is a part of the code. You can actually read it, depend on it, and then just start dealing with it. So for me, and of course, in my limited understanding of compliance, it's just a matter of information, and as soon as that is delivered across the board, I don't think there's any reason for any regulator or institution to not deal with crypto better than average institution, if not at the same level.
So do you think it's more to do within education and a fear of unknown?
Exactly, that's what I'm saying. Yeah. Fear of unknown is a better word.
Yeah, I believe so because when I was having dialogue with Vara and they have shared some checklist with us at the time of onboarding of a VASP, what are the due diligence they do. So I believe the major problem is not at the onboarding stage. It's more on a governance model, it's more on ongoing due diligence and the monitoring stage, which they are still exploring because we do not have a KYCC level controls. But as what Amar said, it's no different than a correspondent banking relationship. And if I have to draw a parallel, possibly it's something, an amalgamation of correspondent banking or an MSB or a PSB kind of a relationship. So we have to draw a line somewhere. But yeah, I somehow feel that you guys have beautifully already explained it. It's more of a fear of unknown, and I think we have to bring that inclusion to the ecosystem, which is missing by far.
I'm going to take one more example, if I may.
Sure.
Okay. We've all heard about humongous scams, money laundering scams particularly, around art. And that has been, the truth of the town for a long time. Just this simple use case, which is sort of abstract in most of the real world cases, because you don't really know if the copy of Mona Lisa is actually valued at a few $1 million or not, or just a good copy of Mona Lisa. I mean, I know, I hope you know what I'm pointing at. But in the case of crypto, yes, you can howl and shout about JPEGs being valued like actually ugly JPEGs being valued at a few $1 million, but there's a math embedded in the platforms that are selling it. So they take the average of all the trades, they take the average of the artist, they take the highs and the lows, they take the mean of that. So the maths is actually in the code. If maybe you don't want to value that art at a certain price, you can at least see the past of it. Not some random copy of a picture, no matter what it is, sold at tens of millions of dollars value, and of course, paying taxes and evading taxes in the meanwhile.
Absolutely, I agree with you. And given there is a commercial data behind, and it's a commercial opportunity for almost all the financial institutions, I think we must explore. If nothing less, we do have certain well-regulated VASP. While talking about the regulated VASP, I think this question is for you, Alina, more. I think we do catch up on these questions offline as well. What do you think, what are the key considerations we should keep in mind while drafting a risk appetite statement for the VASP? When we are onboarding a VASP, how should we define a risk appetite statement?
Sure, I'll take this question with pleasure. And I think there is a general lack of awareness on the market when you distinguish in between regulated or unregulated business. So the exact steps of due diligence, no matter are you a bank or a other licensed financial institution, you will firstly have to look, is that business fall under the definition of VASP? It might be something else, not necessarily VASP. Once you define if it is a VASP, you will look at the regulatory status. And at the times, it might be very difficult to drill it down because of certain market buzz exist. I mean, people are using different words. Secure license, secure approval in principle, getting FSP. Essentially, none of this may undermine and may mean that company actually is live already. So you will have to drill it down. Then you will have to assess the primarily clients of this VASP. Are these professional clients or are they corporate clients? Do they have retail endorsement? This will entail different category risk for you. Then you will have to look what are the assets that this VASP is dealing with. And of course, if a VASP is regulated, in order to get this regulated status and maintain, they will have to stay under regulatory perimeter, which means they will not deal with high-risk assets, let's say privacy coins or coins that have certain features for privacy, or algorithmic coins, because basically regulator will not allow them to do so. Then you will have to assess the AML and CFT controls and checks in place. And again, regulated VASPs, they undergo financial, tech audits, compliance audits, cybersecurity audits in order to get this status and in order to maintain status. On top of this, they have frequent ongoing reporting to the regulator. So this should give sort of comfort while dealing with the WASP if a company is being already regulated and able to maintain a regulated status.
Sheetal, can I just take a stab at maybe going a little high level, is to say, okay, what exactly are the parameters that you need to look at to define for risk? So that's what we're already done. I think education within your own teams about what is the plethora of cryptocurrencies that exist. I'm going to limit myself to cryptocurrencies only. I think at a very institutional level, you need to prepare for the risk assessment and the appetite statement itself. You need to get the right people with technological understanding of what happens with your apps and partners and what kind of technologies they're bringing in so that it is actually defined that you understand the technology. Once you understand the technology, you need to clearly specify what is acceptable, what is not acceptable, and communicate it to the right stakeholders. Because what I'm really looking or experiencing is that a lot of risk assessments are happening by conventional compliance officers who don't have any experience of traceability or any practical experience of having dealt with DeFi or having dealt with centralized exchanges. My view personally as a CCO, you should be looking at the fact, okay, what are the steps that I need to take that my team or myself will be ready to assess all the available opportunities and then be able to create that risk-reward ratio right there. So I just wanted to step a little bit further away and say what kind of preparation needs to be done before you actually even define your risk appetite.
I somewhat agree with you, Babar. And does that mean, for an example, if you're a traditional bank who want to be a participant into this virtual asset industry now, you want to be a so-called crypto-friendly bank, and you have traditional compliance officer or the money laundering or maybe an AML officers, do they need to revamp their compliance team? Do they need to hire people coming from this industry so that they understand the technology? Or do you suggest that they should educate, invest into their people, they should kind of use their existing staff, or what are your personal views around this?
My personal view is get a technologist in and teach them compliance rather than get a compliance guy and learn and make him learn technology. I know it's a controversial view. I'm actually a technologist who came into compliance, and I would say thinking reverse, if I was a compliance person going into technology, it would be far more difficult. So that's my personal view.
I think you're bang on. And now let's talk about the technology. And as I know your background, you are definitely a tech guy. What are the key technology risks you see in the WASP, and how do you mitigate them?
I'll tag team with Gaurav, so he should keep me honest because he's from the technology side. One of the few risks I see is that the technology itself, the blockchain one, and the usage of consensus-based, either proof of work or proof of stake technology in itself is very new. So I view as a developer, a lot of times the code that is getting built is being audited decentralized way, so there is no accountability. So my first risk is that the code and the technology being built is being built by a narrow group of believers in that technology and is getting shipped out and being used. So my view personally, biggest risk is you don't really understand the underlying technology. Views?
I'm just trying to shrink everything I have in my head in less than an hour. I'm still not able to do that. Look, I'm going to just stick to the part that he covered, which is the consensus algorithms are far too tech to dive into, but largely people confuse consensus algorithms. I mean, in the traditional world, and I have plenty of that as well in my network. People think a consensus algorithm in a blockchain essentially is like 15 people sitting in a round table and agreeing to things, right? It's not the case. It's essentially a complex mathematical problem. And when I say that, I mean, whatever you are thinking in your head, just multiply it by 10,000 level of complexity, okay? So it's a complex encryption mathematical method, and people are actually agreeing to continue to the same method because it takes a fraction of effort to agree to that, and it takes a world-changing effort to not agree, and this is the construct of blockchain. So don't ever confuse the consensus mechanism with like, oh yeah, 7 out of 15 will disagree and Bitcoin will fall apart. That's not actually the case. It is far more complex. to disagree to a consensus mechanism. So I would just simply throw this problem off the table in all means, because till date, no single consensus mechanism has been abused in crypto.
Yeah, I just wanted to give an example to the guys because you will understand. Ethereum, the most global chain, actually has changed its consensus mechanism trying to comply with the OFAC requirements. So just maybe share it out there. It's not a criticism. It's actually a positive sign whereby the forum or the consensus people agreed that yes, we would not like to approve blocks or funds where there are entities involved that are sanctioned. So yes, so it is an addressable risk, but it is a risk whereby you will need to understand how this consensus is happening so that you know as a regulated entity or a WASP or whatever, that what you are allowing on chain or you're becoming part of it is actually compliant or not. So I think the technological, and then I think Gaurav has highlighted, the technological complexity is a huge risk for an institution that is in the business of making money. We are not technologists. We are people who are supposed to keep our institutions safe and do safe bets. Banks have a risk appetite whereby a lot of money can be made with zero risk or low risk. I won't call it zero risk, but lower risk. Why should I expose myself to so much complexity? But I think as Mohammad Shah also highlighted, that crypto assets are here to stay.
Absolutely.
And that investment will need to be made.
Absolutely. I would love to believe that. These are the light years. And since we are talking about the technology, my question to you, Amar, and that's for what I reached out to you also. You work for a tech company. There are blockchain analytical tools. Can you just tell me something about that? What has been developed over the number of years to mitigate the financial crime risk for the crypto industry?
Yeah, sure. Thanks, Sheetal. So I guess when it comes to blockchain analytics, it's been a journey as well. So, when we start with looking back a number of years, the initial, requirements were to investigate. There was a lot of hacks, a lot of crime, when there wasn't little to no regulation, there wasn't education, a lot of scams happening. And so blockchain analytics really, was developed to support criminal investigations, and matters of national security when it comes to some of these large, scams happening. And so really what we've done is we've been developing as the ecosystem matures and grows. And as you're all aware, the digital asset or virtual asset ecosystem is a very fast-paced, ever-changing, ever-moving ecosystem. And so when centralized exchanges started, emerging and they were being used, there was a requirement then to actually expand beyond serving the public sector in terms of law enforcement, national security, and broadening the services and the solutions that we offer into compliance and risk. And so really with centralized exchanges, there was a requirement now to start looking at, monitoring transactions, very similar to in the fiat world where you have solutions like NICE Actimize, for example. And then we had the more recent emergence of kind of banks, like say, for example, Bank of New York Mellon, one of the first banks globally that really adopted cryptocurrencies. So now we have a requirement to build solutions for onboarding, whether it's onboarding and banking a VASP, whether it's checking the source of funds or source of wealth of an individual, high net worth individual looking to bank fiat currency with wealth derived from crypto. So as all of these challenges kind of, evolve with the real world needs, our solutions have been evolving alongside those. So really when we look at kind of the early years, it was a coverage of Bitcoin only because Bitcoin was used widely. There wasn't really much happening on any other coins. As soon as Ethereum came out, and then there was a flurry into, okay, well, we need layer 2 solutions, for example, Solana, Cardano, Polygon Matic, for example. Then there was obviously scams and exploits taking place on those platforms as well. And then, post scams, when they're actually being used for real world solutions, applications, and so forth, then it's a requirement for us to kind of, really provide coverage to those chains as well. And then moving forward a little bit now, we're in a position where, not only can we provide, onboarding, banking of VASP solutions, real-time transaction monitoring, sanction screening, for example, but we're also looking into DeFi. So what risks do DeFi pose? When you're looking to invest money into a liquidity pool, you're going to need to risk profile that liquidity pool. Who is interacting with that liquidity pool? Is there any illicit actors? Is there any illicit entities and so forth, like mixers, darknet markets, that are really interacting with that liquidity pool? So as the ecosystem develops, this is what we're trying to achieve. We're trying to make and build, the ecosystem in a safe and compliant way.
Thank you, Amar. I'm conscious of the time, and I have a very interesting question which I can't skip, and possibly this is for you, Alina. We have CBDCs, we have cryptocurrencies, and we have stable coins. What is the difference of the risk assessment, maybe between crypto and the stable coins? So when we do the risk assessment, what are the key considerations you do?
Yeah, first of all, let's recap on what we consider to be a stable coin. Stable coin is blockchain token that is backed by either fiat currency or an asset, or by the basket of assets, or by a combination of assets and fiat currency, right? Which makes it less volatile than virtual assets in generally. So when you will do the risk assessment on the asset specifically, you need to bear this in mind, the nature of the stable coin, right? There are also algorithmic tokens, which are typically excluded from the regulatory regime because they are considered to be of a high risk for regulators and for regulated firms. So aside of traditional key risk attributes, which are market cap, age, technological governance, security governance, ability to trace it with your blockchain analytic tools, compatibility with your custody solution provider, and also sometimes they consider innovation, efficiency, right? When you will be looking in a stable coin, you will be looking at the redemption risk, ability of the issuer to maintain the reserve one-to-one for the stable coin. You will look at the valuation risk, transparency around asset reserve and its valuation. And this is what distinguishes stable coins from virtual assets in terms of the risk assessment.
So does that mean the stable coins would be sitting in the ambit of the federal regulator like UAE Central Bank, or would this also be sitting into the ambit of regulators like VARA?
I mean, it's already clear that token reference to dirham is exclusively under the oversight of the Central Bank of the UAE. However, tokens reference to, let's say, dollar, like USDC, USDT, they might fall under regulatory remit depending on the regulator.
Sure, that was very insightful. Since we are conscious of the time, I have one question for you all. Something forward-looking. What does crypto ecosystem look like in the coming 10 years from now? Maybe I'll start with you, Amar, but you have to give opportunity to everyone to speak and wind up.
Okay, I think I've got a minute, so I'll be very quick. Looking forward, what are we going to see? I think, looking at BlackRock and what's happening with the ETF space, we're going to see, hopefully in next year, an approval at some stage, which is going to really cement the maturity of the asset, bringing lots of volume. I think moving forward, we're going to see a lot of banks that are offering custodial services. We're really going to see a global standard emerge. I think the IMF, Bank of International Settlements, IOSCO, FSB are doing fantastic work to, really create a global minimum standard given the type of nature of crypto assets and their global nature. And so really I see that there's going to be a lot of wealth, both crypto, virtual asset, and real world wealth moving on-chain.
As a trend, I would like to consider wider digitalization of the trade. This is something that UAE regulators already looking forward to. Also, DLT foundations and regulatory compliance on the issuers of the tokens.
There's this tweet from the ex-CEO of Digital Currency Group, Ryan Selke, who's also now operating this crypto intelligence company, Masari. He goes like, we have created a $3 trillion at that time, a $3 trillion industry in about 10 years with no support from the institutions, entirely from the ground up. Isn't that fantastic? The future in 10 years, I'm sure is a exponent, plotted on the same graph, which is, we're talking about a $30 trillion to $50 trillion industry. I'm assuming, US will be creating a lot of dollars, extra dollars, minting, and hence the numbers come from there. We're also talking about programmed money. CBDC is not very far away. She touched pretty insightful topics on stable coins. What we missed is CBDCs.
Maybe next time.
Huh?
Maybe next time.
Absolutely, and that is the future of programmed money, which will be enforced by the governments, and that is very, very assuring on the crypto side of things.
Sure. We almost ran out of time. Maybe the last final thoughts from you, Babar.
Just a funny story that my daughter now takes her pocket money in Bitcoin. So I guess the younger generation is going to define how the future is going to look like.
Wow.
If we're banks, we better be ready. These young guys don't want our current financial system.
That's quite impressive. Possibly I have to go and talk to my daughters as well. So on that note, it was an engaging session, and thank you so much to all our panelists. It was very enlightening, and it was a very informative session. Thank you so much.